Since we last met, the September quarter GDP data showed Australia's economy is growing, but barely. Quarterly real growth of 0.3% and annual growth of 0.8% meant the economy outside of the pandemic was growing at its slowest rate since the 1990s recession. And this annual growth, 0.8%, it was markedly lower than the 2.3% growth in population. What does that mean? Well, it marked the 7th consecutive quarter we've gone backwards in per capita terms. Importantly, for interest rate decisions, to hit the RBA's base case of growth for 2024 of 1.5%, quarterly growth in Q4 would have to almost triple compared to Q3, up to around 0.8%, which is a highly improbable outcome. The growth we did see in Q3, well, it was pretty much all down to public sector spending. Energy cost relief rebates and strong public investment, driven in particular by defence and state infrastructure projects, meant recurrent public expenditure was up some 4.7% on the year. And government spending, it's a really useful lever to stimulate the economy during low growth periods. Unlike the relatively blunt cash rate, fiscal policy allows for a more nuanced approach to provide support to those who are doing it hardest and can be used to help maintain employment during economic downturns. And we've kind of observed this in the employment data. So despite our high population growth relative to where GDP is at, the trend unemployment rate stayed around 4% in 2024. Notably, about half the increase in hours worked last year was in the non-market sector, those sectors underpinned by government spending. Long-term public investments in infrastructure, things like transport and technology, they do create more favourable business environment in the longer term. However, public spending can also displace the private sector by driving up resource prices and limiting their availability, or increasing borrowing costs. So all this raises the question, has government spending prevented a recession, or has it just hindered private sector activity? Well, it depends who you ask. On one hand, over the past 2.5 years, high inflation suggests an overheated economy with limited spare capacity. That implies that reduced public spending would have led to lower interest rates and boosted private sector activity. On the other hand, business surveys and some PMI data indicate weakening private sector employment growth, and the RBA's noted wage pressures have actually eased more than expected. So who's right? Well, the true impact of public investment will become clear if and when public spending starts to recede. Will the private sector pick up the slack, or will the economy struggle? Now, this question is more important to me than precisely when the RBA starts its rate cutting cycle, because it'll determine the size and the speed of the rate cutting cycle through 2025 and beyond. So that's what I'll be keeping an eye on throughout the year. Another major development since we last met is the start of President Trump's second term in office. Lots been written about the US administration's economic policy, particularly on tariffs. So what impact will it have on Australia? Well, at a micro level, individual companies will have highly specific exposure to tariffs, but the macro picture, it's a little bit more complex. See, the impact of tariffs on a market depends on many dynamic, interactive factors. How quickly can supply chains adapt and reroute? And at what cost to businesses in the short term? How will trade diversion impact demand, for example? Between 2018 and 2023, we saw US imports from China decline over 20%, but they increased by almost 50% from the rest of Asia. See, when tariffs are enacted, other importers have a chance to fill the gap. And lastly, who responds and how do they respond? So if the imposition of tariffs escalates to an extent that global economic growth is materially impacted, well, then everyone loses out. So while the risk of a significant global economic event is definitely higher, my view is that the impact will likely be modestly negative at an aggregate level. Australia is relatively well positioned for a few reasons. So firstly, we run a trade deficit with the US, unlike the likes of Canada, Mexico, and particularly China. Secondly, the US comprises about 5% of Australian exports. So that's multiples smaller than our largest export partner, China, at about 32%. And lastly, our equity markets are dominated by financial services and commodities. Now, while commodities are very much in the Trump administration's sights, we're not as exposed to the wild fluctuations recently seen in some technology stocks. So to wrap up, the rapid changes in trade policy create planning challenges for businesses. Australian exporters should stay agile and investigate new markets as US trade policy shifts and exchange rates fluctuate. Exporters highly dependent on specific markets should proactively diversify their supply chains. On the currency side, a continued depreciation of the dollar, well, it'll encourage capital inflows into Australia and increased M&A activity. As beyond the noise of trade tariffs, the US is going to remain the top source of foreign direct investment for Australia, thanks to our strong cultural, social, and institutional ties. Domestically, attention is on when the RBA will cut rates. Now, this cycle is looking less predictable and less uniform than previous ones, given the current domestic and global climates. So businesses should be keeping a close eye on high-frequency data like the real household income outcomes, which could surprise on the upside if inflation continues to subside. Now, while economic activity will probably remain below trend in 2025, a strong labour market, falling inflation, tax cuts, and imminent interest rate cuts will present pockets of opportunity and hopefully leave the trough of this cycle behind us.